Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhart, and Emily Sander.
All right, let's see. Icebreaker question for now. If you had to describe the current state of private equity in one emoji, what would it be?
I'm not going to say fire, like a dumpster fire, because it's not. But yeah, I think pensive, perhaps. You know, that whatever that emoji
Mine would be the one with like the big eyes, where it's like, huh?
No, I'm actually going with the one that's got just the two eyes and no mouth. Like it's just a little round face with two eyes staring out at you. Because I mean, right now, no one knows whether to be sad or happy. They don't know whether to frown or to smile. So there's no mouth. It's just two eyes. A little emoji with two eyes.
Okay. So if you're a PE investor in defense-related contracts, I think you're probably smiling all right. You just want us to.
You might be right now.
This goes where this dates where we're at, but who knows? We might be at war with Iran in another day or two. You never know. So,
what is? Let's jump right in. So I was going to do a hangover question, like True Confessions. What's your worst hangover? But we can save that for a later episode. I think I've witnessed Ed's worst hangover, Dublin. But we'll save that for a later episode. But we did run across an article, more specifically by we, I mean Rory, came across this article. Just touch us off on that, Rory. What's that saying?
Well, it really is it kind of summarizes what we've been talking about, both in our podcast, in our book to some degree, is about basically liquidity in today's market and how
What's the headline of the article?
It's just called the private equity hangover.
Simply stated,
basically what founders need to know about the $3.6 trillion exit logjam. So what that means is that there's a ton of businesses that are actively being held by private equity groups, venture capitalists, et cetera, that have not transacted, meaning they're getting the hold period's long. And there's so many reasons why people are holding on to these assets. Some mostly bad, but a variety of reasons. It's just not as robust of a buy-sell market right now as it has been in recent years.
What is the long-term impact of that if this keeps going?
Well, it could be a lot of things. Not the least of which is people that invest in private equity funds that want to get their money back. They may have to sit on the sidelines and wait longer.
I was going to say on the private equity, part of the component of private equity where private equity guys make their money is velocity, because you want to have deals turning quickly. So you don't want to hold them too long because you get the realization of your upside on that. So from the PE firm perspective, you've got your little 2% or 1%, your kind of run along that you get on an annual basis for management, but you really make your money on a transaction. And that does two things. One, it puts money in the private equity firm's pocket, so they get a realized gain. They get as we've talked about on other podcasts and in the book, they may get between 10 and 20% of the profit goes right into the general partner of the private equity firm's pocket. The second thing is they return that capital back to the limited partners, who then invest in the next fund. And so if the entire system is kind of clogged up, or we've got private equity constipation and these deals aren't moving, nobody's making money. Nobody's able to reinvest because there's no liquidity at the limited partner line. So they don't have the ability to reinvest. And so the private equity guys don't have the ability to raise another fund. And because they don't have an ability to raise another fund, there's no money available to be able to go buy the stuff that's on the market, and it just clogs everything up.
So there's this cadence that it has to run at, and this is like log jamming that cadence. And it's clogging it up we need Metamucil, we need to take some Epsom salt baths, we need to get the logjam through,
Yeah.
whatever analogy you want to use. Because like my question is like, if that continues for long enough, does something just die? Like what, like does
No,
private equity
well,
go?
what'll end up happening, from my perspective, is there's a reason why nothing's moving, and it's a liquidity issue. So there's a liquidity issue where folks are looking at the liquidity they have, their ability to put stuff back to work. It just doesn't make sense to pull the trigger. At some point, if someone needs to get liquid, the prices will start coming down to where folks go, okay, regardless of kind of where I'm at.
Oh gosh, yeah. I mean,
this makes sense. I'm pulling the trigger. I'm going to buy. Now the issue is when you've got when the buy sell spread on these transactions, which is really what we're seeing right now, is there's a buy sell spread that's fairly large. The sellers bought, as we talked about earlier, the sellers bought, or when the sellers bought in, they bought in, 5 years ago to today, which is, I was sitting in the market going, I can't believe people are paying these multiples and companies are trading at ridiculous prices. And during COVID, it seems like everybody was overpaying for everything. Yeah. And now that folks they're looking to sell, their basis in those assets is very high. Mm-hmm. Now, what we've seen is interest rates have risen. So the risk premium goes up. And so as a result, you've got because again, you've got your risk-free rate has gone up. So the risk premium above that has gone up. So the prices come down, and there's a gap between this is what I paid for it, this is what I modeled my return to be, or this is what I booked my valuation as. And this is what the market's willing to transact based upon the current profile of kind of risk premium and discounted cash flow.
Basically, like you're taking a loss.
It may not be a loss from the initial investment, but it may be lower than expected return to either the limited partners, the general partner, or both.
Yeah. I mean, cash is king right now too. So that's another thing with private equity. When we talked about private credit in our last episodes, typically those two go together. But, I'd say in terms of deal flow, the groups that have the advantage right now to buying companies are probably strategics, like large corporations that have an acquisition strategy as part of their ethos. And so there's maybe not as much competition, one might say, against private equity and others that maybe rely a lot on leverage. With Ed talked about it, interest rates are high. They were pretty much zero risk-free rate 4 or 5 years ago. Now you're looking at 7% interest rates plus on just like a paper. And so, whereas, strategics may not have had as much of an upper hand on private equity in a lot of ways. Now they may. There's just not as much competition for deals probably. And then flip it on the other side. We talk a lot in this podcast and our book, et cetera, about founder perspective, right? So if you're a founder that's built your business and you've been wanting to transact, you've been wanting to sell your business, or you thought 5 years ago, hey, if I grow this sucker 5 years from now, I'm going to trade it and get a massive multiple on my EBITDA or revenue or however you want to build that valuation. You're probably rerunning your models these days on, what that looks like. And you might not have as much option as you did before. So you're probably forced with the idea of, do I continue to bootstrap this thing? Do I continue to look at taking on minority investors, whatever, maybe pay for expensive debt, who knows? But maybe you're rethinking things now when you had a different vision 4 or 5 years ago.
So you mentioned leverage. You mentioned taking on debt.
Yeah.
Does a leveraged buyout help you in this scenario?
Does it help you? That depends on a lot of things, I guess. What are the terms of that debt? What's the cost of that debt? What is the advance rate on that?
If we zoom out, what's an LBO?
Oh, it's just simply using debt to finance the purchase of an asset or a company.
So if you don't have cash,
yep,
you can finance this thing through debt.
Yeah, that's right. Yep.
Okay.
And that's the common playbook used by private equity firms, and they largely work with banks that they're really familiar with, private credit funds that they're really familiar with, and it really allows them to put minimal equity down, minimal cash down at close. In typical terms, you're able to use that cash flows from the business to service that debt over time. And then you think about it in a private equity hold period scenario, call it 3 to 7 years. You structure, you'll either refinance that debt out to better terms, or you'll basically transact the business within that time frame before the debt's mature. But I think right now, a lot of businesses are having to face restructuring their debt because they hadn't previously, sold the company, the asset. So it's like, all right, well, I got a bullet maturity on my debt facility. I got to deal with that. And so maybe they're not getting as much, as Ed talked about, good economics on their whole situation right now.
Okay. So, give me an example of an LBO. So at the beginning, I don't have cash, so I might pay, I don't know, I'm making up numbers. Like, let's just pick simple numbers, like 1 million in cash, and then I'm taking on X amount.
It depends.
In debt?
So X is a variable number, and it really depends upon the free cash flow of the target. So what you're looking for essentially. So I'll use an example, a real life example. So you have a company that Rory and I worked with that just spun cash like crazy. So when you look at the kind of the debt free so you look at the balance sheet, you look at the assets, and you have it just no liabilities. You look at the assets, and it's got 100 million of assets, and that 100 million of assets is spinning, 11, 12, 13 million dollars of free cash flow on an annualized basis. When the private equity guys come in to buy it, they go, okay, look, you got this 100 million of assets. We're going to pay you 130 or 140 million. We're going to put 40, 50 million dollars of equity, and we're going to borrow 100 million.
Yeah.
Because the assets that were, as a loan portfolios, the income coming off those will more than service the debt that's on the other side of that we used to acquire it. So, you've got, and on the other side, and we were in a business that was a leveraged buyout where they paid 50 million and put 14 million of debt on it, and would check in for 36. And that was one where it wasn't the majority of the purchase price, but they said, okay, we could get good terms on this note, and it makes our equity, it kind of juices our equity return. So that's a leverage buyout too. It's just less leverage. The issue with that one, as you recall, is, as Rory just noted, there's a bullet maturity. So basically what that says is, the loan pays off a little bit every quarter, but 5 years in, because the PE guy said, well, 5 years we'll have sold this. At 5 years in, the entire balance is due. So it may have been paying down $1 million a year for 5 years on a $14 million note. And then all of a sudden at the end of year 5, they got to stroke a check for $9 million. Well, if they don't have the $9 million, then they've either got to refinance the debt under duress or sell the business to raise the money.
And hopefully sell the business for enough to cover their debt. Yeah. Yeah.
Okay.
Yeah.
So let me recap what I think I just heard. Leverage buyout is a strategy. It's an acquisition strategy. You can use many strategies to get in, but okay. So you're taking on a significant amount of debt, like ballpark, like is this anywhere from 60%, like 90%?
No, it could be anywhere from 25% to 75%. You tend not to, you really effectively don't see much above that in the market where they're borrowing 100% or 90% of the purchase price.
Okay.
Yeah. Yeah.
So this makes sense if you have a cash-rich asset. And private equity uses this strategy a lot. The downside is if you run into these long hold periods, which we're talking about in this current market, your term with the bank runs out and you owe a crap ton of money all at once.
Yeah.
Yes.
And that's one risk. The other, of course, as we've talked about as well, covenants. Like, once you have take on debt, you're basically, you have to operate with a certain set of guardrails, which we call covenants. They're basically saying, if these elements that are set in the credit agreement are not met, there will be consequences of one sort or another. It could be just a financial penalty, could be full acceleration of the facility, et cetera. There's a lot of potential outcomes, but the point is, if you have a debt facility, you don't have as much margin for error with your business. Say something like really problematic happens. You lose like half of your top customers, for whatever reason. Could be a force majeure event. Who knows? Could be anything. You're still on the hook to pay back that debt based on the terms of the agreement, even if the disruption in your business means your revenue and your cash flows have gone down. So there's like real risk to this. I mean, leverage means risk. Leverage means, risk and return, but in some cases on the downside, it can be risky for sure.
Well, I remember like we've talked about, we're like, Ed, you and I at the last company, during COVID, I think, came into that situation where our revenue, we put them on hold because we were trying to be nice to our clients. You don't have to pay us for 3 months, blah, blah, blah. But we got into a sticky wicket situation with the bank because we were about to blow covenants. We were trying to renegotiate terms and they were like, we'll give you new terms, but their rates and like their terms were just in a free fall here with revenue, and you're refinancing this thing, but the terms are atrocious. So they have huge leverage. They call the shots at that point.
Well, it's very analogous to somebody today, maybe like that's pretty, like let's say they have a home with equity in it. But they lose their jobs or something like that. And they need to tap into their home equity, et cetera, or they need to refinance their mortgage to tap into some equity. It's like, it's going to cost you. You're going to have to give up the 2%, 2.5% interest rate you've got on your mortgage, and you're going to have to go to market rates now, which is like 6.5 as of right now. So yeah, you just don't want to find yourself in situations where you've taken on debt. It's no different than in your personal life where, you've taken on debt and, there's disruption to your life or your business, and, it forces your hand
Question
to the lender.
Question. Is there a scenario where it gets to the point where it's better to declare bankruptcy to get debt off of your books?
Yeah.
Mm-hmm.
Yeah. That happens all the time. Yeah.
I was making a comment to a colleague yesterday, kind of doing a little reminiscing on a deal that I had worked on when I was over at Lone Star Funds, which was a accredited home lenders, which was headquartered out of San Diego, and they had just prior to the housing crisis in 2008, they had acquired Ames Home Mortgage, which was a retail mortgage provider. So they had hundreds of commercial storefront leases across the United States. Then the mortgage market stopped. They filled their warehouse because they couldn't securitize. So basically they were stuck with a bunch of mortgages. They couldn't continue to generate. And they had hundreds of storefronts that they were paying millions of dollars a month to keep open. And the only way out of those leases, unless you're going to negotiate each one, is to file for Chapter 11. Now, and my recommendation was file this thing for Chapter 11 and then 363 sale, essentially buy it out of bankruptcy and clean it up. Instead, they put additional capital in, and then a year later filed for Chapter 11.
Oh, no.
Did a 363 sale. Yeah, and bought it out. So, and that was the first time the private equity folks accused me of being defeatist, because I didn't see that. But the defeat was actually, I would have saved them 9 figures had they not gone through that process.
Oh, wow.
But no one anticipated that the market was going to be, again, constipated on the mortgage side that long that they wouldn't be able to clear the warehouse.
Yeah.
Okay. So in an LBO, who are the key players? You have the PE firm, you have the company, you have the banks. Is there a better name for that?
You have the lender. I would say it's the lender because sometimes it's banks, sometimes it's specialty lenders, sometimes it's a bond issue, sometimes it's a combination of all of those.
Absolutely. Yep.
Lender, and then are those the main one, like the leadership team, or
the leadership team? Hopefully, is not. It has to manage, as Rory noted. You've got covenants and you've got all those things. You got to manage your way through.
This is bigger than any leadership team.
Leadership team
is existential.
But hopefully, the leadership team is not personally guaranteed any of this debt.
Oh my gosh, yeah.
And they're not stuck in a position where, and that generally will happen when you've got a founder-led business. Founders often are personally guaranteeing out of their business. And so, hopefully the leadership team is not stuck in that position.
Okay, so we have 3 main players. And then how do those players make money? Private equity firms, the company appreciates in value.
Yeah, company appreciates in value. So instead of putting 100 million, so let's say the company goes from 100 million in value to 200 million in value. The private equity guys, if they didn't have any debt on the books, they made $100 million. They made a 100% return on their investment. Yep. If they borrowed a chunk of the money, so if they borrowed half of it, 50 million, and it paid back with the cash flow out of the business, and they still sold it for 200 million, they made 4 times their money.
Yeah.
But the key there is they have to have made enough cash flow from the operating business to pay off the debt, because companies are sold on a basis of EBITDA generally, and normally debt-free. So when a private equity firm buys a company, normally they don't buy it subject to the existing debt. Normally there's a provision in the existing debt that calls that debt, just like when you sell your house, you can't just sell your house and not pay off the mortgage. Same thing with most of these loan packages. If you have a change of control, the bank can call the debt. And so, if the cash flow has paid it off and they're selling it on EBITDA multiple, EBITDA excludes all debt, excludes the impact of debt, because interest is excluded. So now they went from 50 million to 200 million, and they use the cash flow from the company to pay off the debt. Now, otherwise they might've been getting dividends, but the one thing that and we've touched on it a couple of times. You asked a really good question, and I kind of dismissed it and probably shouldn't have. The covenants have a significant impact on the company's management team. Debt tends to cause what I will refer to, since we've gone to a little bit of this type of analogy, it causes a little bit of a pucker factor associated with the management team, because you now have basically the big bad bank who could take the company, so you've got this third party that's forcing you to run lean. You've got debt service, which forces you to run lean. You don't have fat city cash flow anymore. And again, I've got an example where, I was another Lone Star company. I was inserted. They took a public company private, and it had a huge real estate portfolio that was all paid off. And we went and sale lease back. So we sold all of that. We leased it back. We borrowed a bunch of money. We dividended out all of that to the private equity guys, and basically have this almost like unmanageable amount of debt and leases on a business that previously was run with 5 private jets, with a bunch of, like, the company cars were all Acuras and Mercedes. Then all of a sudden you got nothing. I mean, you're lucky if we were stretching to make the lease payments every month. And that keeps the management team focused on execution.
Sure does.
Aligned.
Okay. Yeah. Okay. So PE firms make money through appreciation, dividends, and the management fees. In the perfect world, when this is going well, that's how they make money. Yep. Okay. Lenders make money through, I'm sure, fees.
Lots of fees. Fees and interest.
Payments.
Yeah. Fees and interest. Yep. Absolutely.
Okay.
And, sometimes, I'll throw it in there. Sometimes there's some equity component. A lot of times lenders, depending on how early stage businesses.
The lenders?
They'll take warrants as form of compensation. A warrant being an option to acquire equity, basically an equity grant of sorts. A lot of times they'll do that. If there's, especially now, I work with.
That comes down to when a couple podcasts ago, when we talked about private debt, and we said that they'll often throw warrants in there or equity kickers in order to increase the value. Well, that private debt is also what's being used to fund the leveraged buyout. So maybe their bank, it's not a good opportunity for the bank, because they've got regulatory requirements that this may be too risky a loan, given their kind of their statutory regulatory requirements or their internal underwriting requirements. But a private lender is going to come in and go, yeah, this is fine, but if you really hit away, I want my interest, I want my fees, a loan fee, a guarantee fee, this fee, that fee, and another fee, and a monthly,
fee on top
service
of that.
analysis charge fee, and you got to put your money here, but also.
Plus, all your deposits, so their cost of capital is extremely low, and therefore they can lend it out at a bigger margin net interest.
Yeah, because the other thing is, normally the bank
Banks
or
are
lender
leveraged themselves.
will have what's called an account control agreement, and they control all your cash.
Yeah. Yep.
Mm.
Literally.
So
Yeah.
in the end, like they own this company.
They own the business.
They own everything.
And they own the business. And as long as you keep making your payments, they'll let you run
They're
it.
fine.
They have first rights to all the cash flow. That's what it comes down to.
But as soon as they think like these people can't run this business effectively, they're gonna.
Well, it's not a they think. It's
gonna results will show.
Yeah, you trip a covenant and you don't cure fast enough, the loan becomes immediately due and payable. And normally these businesses can't write a check to pay off the loan right away. So then the bank has the ability to force you into bankruptcy and take over the business.
I do wonder how frequently that, if ever, actually happens. Is like
rare.
All right, I'm calling this loan, and they're like, fine, fuck you, I'll just write a check, and they do it. Like, how often can that happen? I wonder. I mean, it probably does from time to time, but like very.
I've seen a couple threats where
I see it more like come take the keys kind of threats. But yeah,
I mean, I've been in one situation where the conversation was, okay, we'll toss you the keys.
Yeah.
And normally they come back with a no. Just we'll do a covenant waiver, or we'll change the covenants, but you got to pay us a big fee.
That's the one kind of point of, I guess, leverage. Maybe not the right use of term in this case for a variety of reasons, but the one thing that we all generally know is that banks aren't in the business of like coming in and running operating companies, so they don't want you to toss them the keys and say, come get it. So generally, you work it out, but it can be a costly endeavor for the operating company, which, from as you said, as we incorrectly dismissed, that can impact management teams. If it's like all about, maximizing cash flow and things like that, and, in some cases, people's bonuses are tied to company performance, which may be net income in some dumb reason, but like, as opposed to EBITDA or something like that. Like, every dollar that goes out the door, whether you're paying for fees for, private jet flights or, fees for bank covenant waivers, then it's coming out of your pocket. So, yeah.
Well, I've seen some like C-suite leaders, like mostly sales, just get like one of them cried, and one of them you could just see like he was deflated when he knew his bonus was going down by 75%. He just like lost all kind of.
You want that in salespeople. You want them to be coin operating.
Yeah, but this can take this wind out of stuff. But I remember,
especially good ones that are like the second they, this is a bit of a digression, but just general business. If a really coin operated, really high powered salesman like feels like they're not going to make any money, they're gone. They're going to go somewhere else.
And I remember before I knew what covenants meant, I like you, Ed, and Rory, and someone else at G2 was having a conversation, like, covenants, and I could just see like everyone was super stressed. I had no idea what this meant. I had no idea what you were talking about, but I was like, this is serious. These people are not happy. This is super stressful for them. And like later on in different rounds and companies, I learned, I was like, I'm super stressed, and I have to be a buffer to my team, and everything's fine. Keep doing your stuff. You're doing great.
G2 will always have a good place in my heart.
Compared to a couple of the deals that I've been in. I
was just going to say that, Ed. I mean, all in all, that was probably the company that had the tightest, most predictable P&L and balance sheet light. Thank you, actually, to the sponsor who pretty, as you called out, didn't leverage that business up very much. It was like 33%, something like that. But in hindsight, that was probably the healthiest business I worked for from a pure cash flow perspective. Straight away, I yearn for that again someday.
And we'll end with
perfect for private equity though. We restructured that debt while we were there together, Ed.
Yep.
And we did what you usually can't do, which is kick out a dividend to sponsors while you're still in the deal. We did that because it was
we paid down the accrued preferred. Yep. The accrued preferred dividend plus some of the preferred.
Yep.
So it went well.
Good thing, for so many reasons.
Okay. Yeah. So one of the risks, because I'm trying to think this through, you take on a high debt load if you have a high percentage at the beginning, and the downside of that is there's less cash flow to work with. Like you have a little leash to work with versus if, hey, like we're going to do this 25% at the beginning, then you have a little more room to operate in with cash. Is that
I really like how, for the listeners out there that are not just swimming in the world that we're swimming in here, just to put it in your own world terms, is like, if you buy a house that's really expensive and you need to finance that, and your paycheck is a finite amount, your mortgage payment takes up a bigger proportion of your paycheck. The more house you're buying, call it, or take the down payment equation out of it for a second, but like, you're choosing to take on more debt to buy a bigger house. You don't have to do it, but you're choosing to, which leaves you little margin for error on your other expenses that you have in your life and your pay, right? Same thing happens in business. And that's actually one piece of advice I can give for most listeners that are not as plugged into the day-to-day as we are, is like, business is not that dissimilar to like your normal life, how you manage your checkbook, how you manage your proverbial checkbook anyway, how you manage your balance sheet, which is just all of the things you have versus all the things you owe. It's really similar. It's just at a much bigger scale, generally speaking. So just think about things in those terms and use common sense, basically.
Yeah. Okay. Exit question. What breaks this logjam? Is it like interest rates?
That's a big one.
He's saying like valuations, we're just going to give you what you want. Is it a whole different model emerging? What breaks the logjam?
Well, interest rates, I'll say for sure. Cheaper cost of capital means, generally speaking, people are more willing to borrow to make things happen.
Yeah, I think structurally, interest rate lowering, I agree with Rory. I also think that that's going to be a tough ask, given the
It is going to be a tough ask.
The current macroeconomy and governmental squeezing out of the borrowing base. So I think the other side of that is time will force transactions. You have no choice but at some point transact the business, the private equity folks, and that those valuations, if they all come down and it's a macro factor, the one thing the private equity guys will take it on the chin, because they make money on the multiple up. That's a big component of their compensation. If everybody's suffering with it and everybody's got to transact and everybody's got to go through the process, the private equity guys can at least look their limited partners in the face and go, this is a macroeconomic issue. It's not a us issue. And we're going to transact this stuff, get liquidity, and we're going to go buy in now that the prices have come down. And there's a lot of attractive opportunities out there. So I think if interest rates don't fall, and I don't see that, a dramatic change in interest rates, I actually see them probably continuing to tick up over the next, 5 to 10 years. I think we're going to continue to see rising rates just because of government debt requirements. I think the flip side to that is time is going to cause these to transact, and they'll move on, and we'll hit reset.
Who wins in this economic environment?
They won. They sold it. They sold at high valuations that aren't able to get replicated in today's market.
Is this good for anyone else? If you're like contrarian, this is.
I think the big companies out there that have a voracious appetite for acquisition, they win too. There's tons of cash sitting on balance sheets right now for the very reasons we're talking about. There's, there hasn't been a lot of other avenues to spend. A lot of people are plugging money into technology, innovation, stuff like that, where maybe they were buying it through acquisition before. Now, I'd say, prices are going to go down. So if you have cash and you're acquisitive, you're going to win, especially if you're buying good businesses.
I think Rory hit it on the head earlier with strategic buyers have largely been getting forced out by private equity buyers who were overpaying, essentially. So the strategic buyers, the private equity was paying strategic buyer pricing, assuming, that there's going to be another upside. I think the real winner here is going to be the strategic buyer who can get cost synergies, who can get, strategic synergies with those acquisitions. They're going to be willing to pay more than a private equity buyer. And the private equity buyer is now going to be having to set their sights lower, and it'll be less competitive for the strategic buyer to be able to make some of these key acquisitions for their corporate portfolio.
Yeah.
Do you think this changes exit strategies or the exit environment forever? Or do you think like in a year or two, it'll go back to how it was?
Boy,
I don't see a year or two, but I do, and I do think, I actually think the last 5 to 7 years have been more of an anomaly. And if you look at the long
plus side,
if you look at the long history, the long history is private equity tends to buy smaller, undervalued businesses that are private, that aren't on the strategic radar. They grow them, they make them ready for institutional money or institutional purchase, strategic purchase. Strategic buyers buy them, integrate them into their business, and then it's rinse and repeat. Or they buy businesses that are larger, and I'll use like the RGR and Nabisco, from back in the day, back in the 80s, where the company is big, fat, and not being run effectively as a public company. The private equity guys buy it, they strip it down, they put debt on it, they use all the tactics that we use today, and then take it back public later. That's been the norm. The last 5 years of private equity flipping to private equity and the prices going up and up and up has not been the norm. And so I do think instead of it being a permanent change, I actually think it's like back to normal for the industry.
Yeah. See it. Yep.
Final call. Anything else on current market or leverage buyouts, what they are, how to use them, what to think about?
No, just make sensible choices. Use common sense. If you can't afford it, maybe don't buy it or finance it. Like it's just simple principles, I'd say. But look for value out there. That's the other thing too. Mm-hmm. If you have the wherewithal, there's value to be found because of this lack of liquidity and lack of financing option that relative to what it has been the last 5 years or so. Yeah.
I think apply common sense is just a good life philosophy.
I know it's an easy answer, right? But sometimes, sometimes it defies things that
not a lot of people have it.
Yeah.
Not a lot of people have it, surprisingly. Yeah. So that's a good one to end on. Apply common sense, apply judgment to all of your decisions. Yeah. And we will catch you next time on the Private Equity Experience podcast. Thanks, Ed. Thanks, Rory.
Thank you.
Thanks, guys.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.